Hey guys, it's Thomas and Dan, and welcome back to the Mitch Murray Podcast. This is episode 6. Today's episode, we're going to be talking about credit. What is credit? Why do you need to have good credit? And what are the benefits of having good credit also? Dan, credit, what is it?
So we're going to get right into it. It's such a big topic, a big item in our industry, because whether you're buying a home or investing in real estate, at some point you're going to need money. And when a bank is going to give you a loan, what are they really looking at? They're looking at your credit, your assets, and your income. That's what they're really... And credit is... credit can kill a deal, where your income might not kill the deal, it might limit the deal. Your assets might not kill the deal, they might limit the deal. But, you'll have a lender that'll say your score... can't be below this number or something like that. And then if you have negative items on your credit, you'll have lenders that'll say, these items can't be there, or they got to get removed, or it's a collection item. So credit is probably one of the most important items in our industry as far as building your credit to a point where you can get qualified for financing to buy a home or to invest in real estate. This is particularly important to me right now because Sophia it just turned 18.
Right.
So, and her and I have been talking for years. She knows about our business. She's been, not that she's been involved, but she's been aware of like the stuff that we do, the stuff that we do in Detroit. And she's questioned me. She has a lot of questions about how it works, how the funding works, financing. We used a lot of our own money in the beginning, but you and I both know eventually you run out of money. You need somebody to step. You need funding if you want to continue to grow. So we just got her first credit card. She just turned 18 in September, and she was excited yesterday. She got a credit card with a $1,000 limit, and our goal for her is to, and we talked about it yesterday, our goal for her is to be able to buy a home within the next couple of years. Before she turns 20, it would be good for her to be able to buy an investment property. Mm-hmm. And we know that these investment loans, if you're getting one of them, we just talked to a lender yesterday for a couple deals, and it's tiered. The pricing, you get first of all, a below 680 credit score, they're not funding you.
Yeah.
And then 680 to 700, you're getting funding, but you're paying a high rate.
He said every 20 points.
Every 20 points. So if you're over 700, that's better. If you're over 720, that's even better. So our goal, me and Sophia, is, and this is one way for young people to establish credit, this is what we're going to do. The credit card's coming in the mail to her. We're going to add me as an authorized user. And then these credit card companies, what they do is you're scoring, not the credit card companies, I'm sorry, the credit reporting agencies, what they do is they score your credit based on these algorithms, and one of the big items is called credit utilization. Mm-hmm. And they want to see how you utilize your credit. Well, if you only have a $1,000 limit, it's not a lot of utilization that you can do or not do because it's only $1,000. But what me and Sophia are going to do, we're going to add me as an authorized user, and a lot of the expenses that I pay on a monthly basis, we're going to pay them on her credit card that I would pay off. So we're going to start showing this new credit card company that she has this history that we borrow the $1,000 every month and we pay it off every month. Mm-hmm. So the balance will always be zero. And what that'll do is it'll make this credit card company think, hey, this client can afford a higher credit limit. And they'll increase her credit limit because we're showing them a good payment history. This will happen within 6 months. People can do this. It's like a little credit hack to build a younger person's score. So now, if we do that, hopefully that credit card company increases her limit to $5,000 or $2,500 in the next 6 months. I also added her as an authorized user on one of my credit cards that has a very low balance or no balance. So now She has 2 active trade lines on her. She just turned 18 in September. She has 2 active trade lines on her credit. She already has a credit score, and now we're going to increase that credit score by doing this.
How hard was it to add her on as a authorized user on your credit card?
You know, that's a great. So there's 2 things to consider. You can add anybody as an authorized user to a credit card, but you want to add the person as an authorized user in a way that it's going to get reported to the credit agency. Okay. And here's the thing, if the credit card company, like let's say I wanted to add you, I can call them up and say, hey, I want to add Thomas Wilmer as a authorized user. They're going to say no problem. They'll mail you a card. It'll be my account. It'll be a different account number on the credit card, but it'll be under my account. It'll have your name on it. But that history of that card won't get reported on your credit unless I give them your social security number. So to add the person, so years ago I added her, when she was in high school, I added her as an authorized user.
But not with her.
But she was under 18. They didn't even care. She couldn't have a credit profile. So as soon as she turned 18, I called them up and said, I want to add her as an authorized user so that it reports on her. And it was a little bit of a fight to get this done. But I said, they said, well, it does report. And I said, well, how does it report if you don't even have her social security number? And they tried to tell me how it reported, but it didn't make sense. Anyway, we got it cleared up. I gave them her social, and now we added her. So now she has a credit profile, which is important, and we can build on it. So parents of young people, like teenagers and people going into college, this is a good way to, look, in the next year she's going to have a good credit score and a good credit and no debt. We're not going to add money on these credit cards. We're going to be smart about it. And the great thing is, for her and I, is she's asking me questions about it.
Right.
So she's 18, first year in college, asking me questions about, you and I talked yesterday about a personal financial statement, and I threw that at her. Like, I want her to learn how to handle these balance sheets and personal financial statements and credit issues. So she's learning about it. And the credit utilization topic came up between her and I yesterday. So she's learning,
But this is one of the problems, though, that I think that young adults get caught up with. When I went into college, I did grab a credit card, but I was 18. I didn't know what I was doing. I was running the credit up, and then by the time you're out of college, your credit is shot. So luckily, in this case, Sophia has somebody that she can really lean on in this experience, because a lot of kids that's getting out of high school, their credit is shot by the time they can even probably buy a house or a car.
Yeah, and really, I'm not blaming the parents, but a lot of times
the system is messed up,
and a lot of times parents are glad that your parents are probably just happy you got to college. Like this was an issue. Now I'm placing more of a priority on this financial literacy stuff that they're not going to teach in college, because I want her, because I know, and I told, one of the topics came up. I said, Sophia, because she then asked me, well, what are your credit limits? What are your balances? She started asking me questions. It was good. It was a good conversation. And one of the things I said to her, it's good to have a good credit limit in case there is an emergency. What if something happens and you can't work and you need to... I'm not saying it would be a good idea to borrow money, but
just in case.
Just in case. It's good to have $25,000 available in credit, so that, when you're living your life, if you do you lose your job for a month, or or you medically something happens, at least you have some, reserves in credit. And that's not the best idea, but in an emergency, it is good to have that. And we do, it's something else.
High schools should be forced to teach kids a financial literacy class in high school, like all the time, especially when you get into your senior year, because you get into the real world. Some kids don't go to college, and then bam, all this adult stuff start hitting you from all these other all sides of the aisle. You don't know what's going on, so and you can make some bad decisions and be stuck. When you have bad credit, it is bad out there. It's terrible.
Well, it's funny now that you say that. Imagine, think about this. We both talk about this all the time, because we see a lot of applications. We do a lot of credit screening, and we see these applications. We see the student loan debt.
Yes.
Oh my God! You look at this student loan debt that people are carrying. it's unthinkable. Like, I wonder.
It's even worse when somebody is $100,000 in debt and they're not even in the field that they went to school for, or they're not even working towards that anymore.
Yeah.
And that goes nowhere.
Or we see it, they're not even finished school.
Yeah.
And they gave up on it because now they got $40, $50, $60, $70, $100,000 in student loan debt. Yep. And you realize, wait a second, when that's why it's good what you just said. If they were to go into a class where they learned about this stuff, it might make them think about this decision they're making in that next year to take on all this debt to go to school. It might shift their perspective. Now, Sophia was fortunate. We had an opportunity to, review that and limit what her student loans were going to be, but which is not going to be. She's not going to leave school with $100,000 in student loan debt. And we wanted to make sure of that. But you're right. That student, that class, she did have a class too, but it was generic. But it is a start. But I agree with you that should happen. All right, so the next thing we're going to move into is the score. So you got a little indication of establishing, building credit. That's the way it kind of works. You got to create a payment. You got to create a credit account, which we call a trade line. You got to create a payment history. You can't ever miss a payment. You can't ever be more than 30 days late. Once you're more than 30 days late, now you're taking your score backwards. All the three credit bureaus in their algorithm is always punishment for more than 30 days late, and every 30 days beyond that. So if you go 60 days late, greater punishment. 90 days late, even greater. 120 days, 150 days. When you get to 6 months, 180 days late, your credit will be hit every month for that 6 months, and then it's going to go into something called a collection status that will make it even get hit again worse. So don't ever go past 30 days late on a trade line. And then you want to show financial management skills of the trade line. So if you have a $1,000 limit, you don't want to ever have a balance of more than $300.
So 30%.
35%, something like that, and then you want to create that payment history. And like I said, what we're going to do is 6 months of history with this payment where the balance is always going to be zero. I know I said we're going to use $1,000 a month, but we're going to pay the $1,000 every month so that every reporting period for her card, it's going to show zero balance. So on her credit, it's going to report a zero balance or maybe a small balance. We're not doing the borrowing the $1,000 and paying it back off for her credit. We're doing it for the credit card company to be able for them to say, hey, this is a good client. They're paying all of their balance every month. It'll give them the ability to increase her limit, which is what we want her limit to be increased. So then now the credit bureau will see, oh wow, this person went from a $1,000 limit to a $5,000 limit, and now her available credit is $5,000 instead of $1,000, and her credit utilization will be even greater from the algorithms. So, and of course, there's other trade lines. If you have a mortgage is the best debt to have because every month that you pay it on time.
Especially if you pay it on time.
If you pay it on time, it's reported positively every month on your credit profile. Again, that length of credit history is important. All right, so anyway, you got a sense of that. And remember, we're not offering a credit class so much right now. We're just doing a podcast on it because we know how important it is, and we want our followers, our people that work for us to know this, people that are talking to clients, people that are buying houses, people that are trying to invest. We want them to know this information. All right, the next thing we're going to get into is credit scoring. Now, the credit scoring, we just talked about in the beginning, some of these lenders have a threshold.
Yeah.
And it can't go below a certain number. But you can easily see a swing. And, Scott knows this, Paul knows this. You can easily see a swing. You could see a swing of 20 to 30 points in a very short period of time based on certain factors. And there's so many factors I can't really get into it now. Like, the way to get into it is contact your lender
and get a report.
Get a credit report, right? Scott knows this, and Paul knows. Most loan originators know this. If you get the report, you can review it with the person, and you can easily identify, hey, you gotta, pay off this collection, or you gotta lower this balance. A lot of times it's lowering a balance because that will affect your score. If you have $10,000 of credit and you're using all $10,000 of it, and then now you're maxed out. You're paying 100%. You're using 100% of your available credit. And in 1 month you pay it down to zero. You pay the whole $10,000 off. Your score is going to increase dramatically. And in your second month after you do that, it might increase even more. Right. So there's a way to get your scoring. What's the best score? The scoring ranges you see on these models, it'll say 350 to 850. It's rare you see anybody with 350, although we just had somebody tell us that they had somebody that was 420. Yeah. And there's some zeros out there,
I had some people before that were trying to buy a house, and, one girl had got pre-approved, but it was with that NACA deal. And we both know NACA is just terrible, but NACA is for people that have credit problems below 600.
And they tell you it'll take a year or 2 years, and then you're in it. Now, then you see max scores of 850, and you never really see that. A score of 850 is usually somebody much older that has a real long history. I had somebody that we ran their credit, and they had a Sears card from like the 1960s.
Wow.
Like that's how long their credit was established. And they were close to that 850 threshold. But you see, I think even yesterday, the lender we were talking to is
780 was.
780 was, yeah. But it didn't matter. I think it was 750.
750 and above.
So you could be 750 or 800. It didn't matter to that lender because you were perfect. So you can get to 750, great. But between 720 and 750 is considered a good score. If you're a first-time home buyer, 720 and up, and Scott, you can correct me if I'm wrong, I don't think it matters as far as the pricing. If you're getting a conventional loan or an FHA loan, I think if you're above 720, the pricing is relatively the same for a low down payment.
A little bit of a difference. It used to be 760 and above was all the same, but now it's 780 and above. So every 20 is going to change.
Okay.
Could you talk about the not closing accounts?
Okay, yeah, that's a good point.
I had someone who was an 800 score, and they closed all their accounts, and they had no credit history.
All right, so I got that on my list. We're going to get to that when we get to derogatory items. So quickly, we'll go through this. The history, credit history is important. So one of the challenges for Sophia is she doesn't have any credit history because she just got it. So that's not going to be great for her. But the sooner you start, the quicker. If she waited until she was 22 to get a credit card, well then it would take longer. So by the time think about it, now when she's 22, graduating school, she'll have a 4-year credit history. So you need to establish a credit history, and the next thing that we're talking about is the algorithm of the credit bureaus. There's Experian, Equifax, and TransUnion. Each one of them have an algorithm that reports the scoring. And the scoring model, if you notice, they're all different all the time. We got into a fight with the one lender about this because, the scoring model, one of them was 730, the other one was 700, and then the other one was like 678.
You're totally off.
Yeah. Why was it so different? Well, I don't know exactly. I mean, there are some factors that we do know about, but
is there one that's more important though out of those three?
Well, that's why credit report. The credit bureau.
Credit bureau.
No, because what they do is they just use the middle score. So in that situation, they use the 700. But we would have got a benefit if they would have used the 730. 730. And they won't do that.
Yeah.
And then if that 700 was below 700, let's say it was 699, they would have had to use the 699 and would have hurt us for the qualification. So, but there are important factors anyway, and one of them is length of credit history. They all factor that. They all factor the credit utilization. If you're maxed out, your score is going to be lower. So you want to pay attention to some of those things, but there is an algorithm for the scoring that does factor in, and all of those things matter. Credit utilization, length of credit, the debt, or not the debt to income, the types of loans. So some debt is better. Mortgage debt, we just explained, is very good, because that means you demonstrated to a lender, think about it.
You were able to get pre-approved, buy the house, and if you've been making payments, that's even better.
But think about this too. Sophia just got $1,000 the bank gave. What's the bank risking? Nothing. Right? When a bank gives you a loan for $250,000, that's a much different world that you just got yourself into. Mm-hmm. Now it's $250,000 that a bank just lent to you. So that means that the reason why there's a priority on mortgage debt is because it's harder to get than a $1,000 credit card. So you've demonstrated this ability to show a lender that you're qualified, go through the steps of obtaining a mortgage, and then doing it. Mm-hmm. So mortgage debt is better. That factors into this. Student loan debt is a term loan. So term loans are typically better than revolving debt. Revolving debt means it's going on every month. Mm-hmm. And, a revolving account, if a lender wanted to, they could just close the account. They're not obligated to keep it open. Right. So
student loan ain't going anywhere.
The student loan's never going away. And by the way, student loan debt is bad in that regard because now I guess there's some element where there's student loan debt forgiveness, whatever that's worth. That has come and gone a little bit, and then might come back. But you have a student loan for $100,000, you never can get out of it. It takes a priority over every other lien, and you can't even if you got in trouble and needed to file bankruptcy, you can't include it. So you could say, I can't pay any bills, and the federal government for student loans saying, fine, we'll give you bankruptcy, but this bill you're going to have to keep paying. So that's something that is important to consider as a young person. All right, so now we want to move into the derogatory part, like where we were just talking. I forget who we were talking to, but they had tenant screening where they had a derogatory account. So I'll quickly try to go through this. I just mentioned it before. If you're 30 days late, you get punished. The score will go down. If you're each time you exceed another 30 days, you get punished again. But the funny thing is, and what happened to this person is, they were 180 days late. So they hadn't made a payment in over 6 months. Once you do that, the credit agency whoever is giving you the credit, they will close the account. They'll consider it a closed account. It'll say closed by credit grantor, and it'll say collections. It'll move it to collection status. And that is one of the items on your credit. If you have, it'll say open accounts, closed accounts, derogatory accounts, collection accounts. So there's different categories for these trade lines. The worst one is collection. Once you get to collection, though, it stops reporting on your credit. So it stops hurting you.
So you shouldn't pay it off.
It's not that you shouldn't pay it off, but when you do pay it off, guess what?
So it's come up to a closed account?
It's going to show activity on a bad account. So now it's going to bring that to light, and the next thing you know, these algorithms in these credit bureaus, they punish that. Only one time though, because when you have this collection account, when you go to satisfy it or pay it or make a deal to pay it, now the credit, that closed account, they have to report this activity to the credit bureaus again, which is a negative account. So they're highlighting it. You're going to get a hit on that score. So if you're trying to bolster your credit score, like this person was in order to apply for a rental, they were hoping, I'm going to pay this off so it's no longer on my credit, and then therefore my score will go up. And actually, it was the opposite. If they would have paid it, their score would have went down. Now, eventually, it would have been better for them in the long run. They're going to have to face the music on this account. So they're going to have to pay it at some point, or it lasts for years. It could be 5 to 7 years on their credit. So these things really hurt you. The negative items on your report, 30 days late and so on, hurt you. Having collection accounts really hurt you. And Scott just mentioned something. If you think you have an account and you don't use it and you want to close it, once you call that credit agency, that bank, that lender, and you say, I'm going to close this account. Well, once you close the account, now that reports negatively. It doesn't matter if you were the one that closed it or the creditor closed it. It's now showing up as a closed account in your credit. And these algorithms for these credit bureaus, Experian, TransUnion, and Equifax, they report that as negative, and it will hurt your credit. Now, it will be easier to recover from that. It's not like that will hurt you permanently in an ongoing way. It'll actually hurt you as a one-time hit on your credit. So if you have these derogatory items on your credit, if you have negative items on your credit, before you just decide, hey, I'm going to do something about this, it's best to talk to somebody who knows what they're doing, knows how credit works. And the best people to talk to are usually lenders that are in the business, like Scott or Paul, that you take a minute, 5 minutes to talk to you about your credit and say, don't do this or do this. It's best to get somebody, or us. We might talk, somebody might call us. We might know some of this stuff, but we also ultimately will say, hey, talk to my lender. Here's their name and phone number. All right, the last thing we want to get into is the purchase money. Qualifying for a mortgage. Now, we're in this business, like we're investors and we're using financing. We have other investors that work with us. We're using financing to acquire real estate, to develop it, hold it, sell it, rent it out. Like we're investors. That's one world. And then this other world that we're also involved in is helping people buy a home, either for a first time or if somebody's stepping up or stepping down into a home, they might need financing. So how does it work with that? And but that's the most important. Like when we're first talking to a client,
I ask somebody, let's run your credit because I don't want to waste your time and I know you don't want to waste my time. The best thing we need to do, run your credit. Let's see where you're at because you need to have at least a 620 or higher to even get a pre-approved for a FHA loan or maybe not a conventional loan, but for FHA, I think the minimum is 620.
Well, I think Paul just told us too he could go as low as 580.
Yeah, but there's going to be a lot of stipulations.
Yes, when you see somebody has a 580 score, they got their credit, they got marks on their credit.
Yes.
They got a lot of these derogatory items that the lender might say, yeah, we'll lend with 580, but then we need you to clean up these 6, 7, 8 items.
And when you submit an offer to a listing agent, they're going to be looking at some of the conditions to get the loan to go through. That's you do that all the time. As soon as you get an offer from a person, let me see the conditions, and then it's going to be a list of stuff that this buyer needs to do. And sometimes you're just like, wait a second.
Yeah, how likely is this?
Yeah, how likely is this person to get all this done in 45 days?
Yeah.
So
yeah. Well, the main thing we want to tell our clients, for like you just said, we want to steer them to talk to a lender, get pre-approved, and you know what I don't like in our business? I don't like that lenders do this. I mean, Scott and Paul can confirm with us. We know that we trust them. We know that they're acting, ethically, and they're, trying to do a good job for people. But I don't like, I just had this happen. I don't like that I asked the lender, well, did you review because credit is easy to review.
Yeah.
When they first talk to somebody, they pull their credit. If the score and the credit report is okay, a lot of these lenders are quick to offer a pre-approval.
Yep.
Instead, and this is the problem with this one deal, is they never looked at the income. So they talked to the client said how much they made. They failed to say that they were self-employed. So they just said, I make I think it was $85,000 a year. But they made $85,000 a year because they got a 1099 for $85,000. But then they had all these tax deductions that made their income significantly less, and the lender issued a pre-approval based on the $85,000 and never bothered to ask, let me see your income. And it's always better to deal with somebody. We say this all the time. Why don't you deal with somebody who's local? Yeah. Why don't you deal with somebody who's,
or the
on
person
your team?
the person that, the real estate agent, every real estate agent has their own, lender.
People they do business with.
Come on. When things happen, you want to be able to call somebody at 6 o'clock, 7 o'clock at night. A lot of these people that's using lenders from California, Arizona, Texas, who are we calling?
Yeah.
If there's a problem.
Yeah.
And in this business, problems happen all the time.
Every deal. And we don't want the blowback. So if we're giving the deal to Scott or to Paul and they're handling the financing with this customer, they know we trust them.
Yeah.
They're going to take care of that deal. And if it's something that's sticky or that they can't get done or it's going to be a problem, they're going to get in front of it because they don't want the blowback of blowing up a deal for us, and then what happens in the future, we don't trust them anymore. So if you're a home buyer out there, I know you want to be, you think you're smart enough to go navigate this on your own and to not listen to your real estate professional, and you're talking to somebody in Minnesota that's doing mortgages
or
in Pennsylvania. Yeah, or you're talking to family members that say, "Oh, I did this deal with this." It's better to use the local person that has a reputation locally.
And they know the landscape of what's going on around here.
Yeah, they know the little details of the transfer taxes and the nuances of the industry in our region.
Yep.
And they don't owe the real estate person anything except this loyalty that they really know. They trust this person. They have a business relationship with them. It can make all the difference in the world. Use somebody local that you know, that you trust, that is referred to you, and then you'll get the best service, in my opinion, and you'll get the combination of having a team where we could talk to Scott, me and you, we could talk to Paul, we could say, hey, what's going on with this deal? Is there something we could do? Can we step in? So anyway, this that covers a lot of the stuff that we wanted to talk about. It's preliminary. This wasn't like some class, but at least it gives you some insight, and it gives our agents some insight, the people that are watching our videos, gives them some insight, and might open the door to some more questions and, a little more conversation about this stuff.
Well, I took some notes on the benefits of having good credit, which is, after this conversation, everybody should know that having good credit is essential. But one of the things, access to loans and credit cards. A good credit history makes it easier to get approved for loans, credit cards, line of credit, and you get higher limits and better terms. We know that just from our conversation yesterday. Hey, if you were at 730, you would have had a better, payment on this loan. Okay, can we refinance it?
Yeah, and one of them, it was like 3%.
Yes,
difference.
That saves us money. Lowering borrowing costs. Lenders use your credit score to decide what interest rate to charge you. We have a lot of experience in that. Housing opportunities, where you live, the Promenade, you're not getting in there unless you have A1 credit.
Right.
So it definitely helps to have that good credit to get into a really good place to live. Employment.
Some jobs. The police job.
The police department. When I first applied for the police department, one of the first things they tell you is, okay, we got to run your credit. Or what is your credit? But most of the time they run your credit because if you have bad credit, it could lean you to do something that
is shady.
Yeah. So that's definitely a
and other jobs want to. Other jobs may want to do that. They may not want to take an employee that has bad credit. They have the right to run credit for someone.
Yeah, and then another thing that you touched on: emergency flexibility. Things happen. It's life.
Yeah.
You might lose your job. Your
car might break down.
Your car might break down. Your spouse might lose the job. It's always good to have some sort of credit line where you can go pull some money out just for a rainy day. So having good credit definitely is beneficial in anything, buying a car, buying a house, emergency cases, anything. So if you guys have any questions, you can always reach out to me or Dan, and we can get you in contact with the two good lenders that we do business with all the time. They can print you out a credit report, and they can go over with you what you need to do, how to bring up your credit as fast as possible. You know, some people's going to take longer than others. Like somebody just came in the office, said they had I think it was a 400.
Yeah.
That's going to take some time.
Yeah.
You know, you're probably going to have to do some...
Couple years.
Yeah. But people that's on the fringe, 600, 620, you can definitely bring it up to the mid sixes, or, you know, maybe the high sixes if you, you know, put in the work.
And make the right moves.
Make the right moves. Yeah. Thanks for checking us out. Always be closing, guys.